and welcome to this edition of Closing Trades right here on ET. Now, a little bit tempered. That's how the day has been. It started off that way, saw a little bit of jagged edges in the first half of today's trading session. And from there, we've just about languished. Down 80 points as we speak right now. But important updates coming in. PM Modi led the central government is going to chair an all-party meeting today at 6 p.m. on the Pahalgam issue. In fact, sources are telling us that the crucial meeting is likely to be headed by the Defence Minister Rajnath Singh himself. In addition, we'll have the J&K PM Omar Abdullah, and he has also called an all-party state meeting at 3 p.m. In fact, my colleague Samir Dixit is here to tell us more about both these meetings and what possibly could be the outcome.
Following the big diplomatic strike on Pakistan, now the central government has called in an all-party meeting today that is going to be chaired at 6 p.m. and headed by the Defence Minister Rajnath Singh. What we are picking up from our sources that this meeting is also to be attended by S. Jaishankar, the External Affairs Minister, J.P. Nadda, who heads the Health Ministry and is also BJP Chief, is also likely to be attended by Amit Shah, Union Home Minister. This all-party meeting, the invite has been sent to all the opposition parties, and it is very likely that the political leaders from the prominent parties, whether it be Congress, Samajwadi Party, NCP, Aam Aadmi Party, they are likely to attend this meet. The primary purpose of this meeting is to get all the political parties on the same page when it comes to give a befitting reply to Pakistan. Sources have informed that the Pahalgam terror strike, the detailed discussion will be done on this particular meet, where the government will apprise all the parties that what led to the terror strike and how the government has retaliated the big decisions taken at the CCS, the Cabinet Committee on Security that held last evening. So the decisions that have been taken, why those decisions have been taken and what sort of implications it will bring in. So to get the confidence of all the political parties and also to get them on the same page, this meeting has been called in by the central government. But it is not just one meeting. A similar sort of all-party meeting has also been called by Jammu Kashmir Chief Minister Omar Abdullah in the state at 3 p.m., where he has invited the political leaders of the political parties, the MPs in the region and other prominent figures of the state, where he will be discussing that what could be the implications of the big decisions that has been taken by the central government and how the tourism is adversely affected and it could be revived. So these are the two important meetings taking place, and which will definitely have an eye from all the citizens of India, from all the political parties, but across the globe they will be looking at that what major outcome comes from these two important meet.
Friends, today, from the soil of Bihar, I say to the whole world, India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished. Every effort will be made to ensure that justice is done. The entire nation is firm in this resolve. Everyone who believes in humanity is with us. I thank the people of various countries and their leaders who have stood with us in these times.
All right, so that is the Prime Minister and his address to the nation, talking about what exactly happened in Pahalgam and the massacre. But let's move on then and let's talk about the markets. And if you look at markets, like Aisha mentioned, it was a subdued day of trade coming in for the Indian markets. Yes, one of the reasons being that you have the markets taking a pause from the relief rally that we've been seeing. And today you have the Nifty that sub that 24,300 mark. Let's bring on board our guests for today. We have Kunal Bothra as well as Sandeep Sabharwal joining us. Good morning, gentlemen. Thank you so much for joining us on ET9. And Sandeep, if you look at the markets taking a breather, and would you say it's just a breather, looking at the way how the markets are performing today?
So I think after a rapid rally of nearly 10%, it's obvious that markets could stall for some time. And I would think that the markets could run up potentially another 500-600 points and then have a reasonable correction before setting up for a further up move. I think overall directionally it's a buy and decline market, and we need to look for opportunity. The result season has been reasonable. So the expectations from many companies were low for this quarter, and results they have been coming in line with that. Some companies have been reporting decent numbers also. But overall, the outlook of most of the sectors and companies seems to be better for the current financial year vis-a-vis the last financial year, except for the technology sector where things are still hazy because of a potential recession in the US, depending on how the entire tariff thing plays out. But I think there also the stocks have, the slowdown has been built into the stock prices. So I think Indian markets and the economy are reasonably well placed.
Be well placed right now. Look at some of the movers though today. Syngene, their FY26 guidance, of course, is significantly below the expectations. A likely 25% EBITDA cut for FY26, definitely not going down well with the street. Look at the kind of hammering the stock has been taking today. 12.5% lower is where that stock is. Having said that, giving it company are also names like Unilever. Sandeep, in fact, wanted to ask you, what did you make of Unilever's volume growth?
Yeah, so the results were more or less in line with expectations. I think the markets have got spooked by the indications of a lower gross margin in the near term as they try to invest more and try to grow a bit more faster and invest in new categories. But I think that's fine. So I think nothing much was expected out of consumer companies in any case till the March quarter. My guess is that from this quarter or next quarter, the growth in many consumer companies will start surprising on the upside as the interest rate cuts play out and the tax breaks given by the government in the last budget play out. So I think corrective moves in this sector should be used to buy for those who don't usually own these stocks rather than look at selling them on negative news, because it is most of the stocks have corrected. It's not that they're going to run away. So I think there could be opportunities on days when markets are more volatile, there are corrections, etc. But directionally, I wouldn't be negative on consumer stocks for this year.
Within consumer, Sandeep, what's looking good to you? Because it's a large pool. Staples is only just, one segment of that. And again, within staples, I mean, names like Marico have been one of the best performers, and it's not quite the case for the Unilever or an ITC. So what would you pick within staples if that's your top pick?
That's not my top pick, but I think these stocks will do reasonably well because these companies typically you're not looking for 40-50% returns from these companies. I think 12, 15, 18% from such companies is reasonable returns. So I think across the board, the larger consumer companies, Godrej Consumer, Tata Consumer, Dabur, even ITC, HUL, I think at various points of time, they'll give opportunities to buy. And then on the durable side also, the larger companies will give opportunities. So I think we have to look for that. Current quarter results will not be good. Like some have reported, some more will come. So I think we shouldn't look at those. So if they end up creating some correction, then we'll be looking to buy.
I mean, if staples is your topic within consumption like that. But here's the Unilever management, and they're pretty confident about what the future growth is going to be. In fact, they shared an aggressive investment pipeline as well to expand their product portfolio, adding that they will always prioritize growth over profit.
Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years. And we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future. building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We have operationally quite robust. Our brand powers is strong and getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are the best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'll be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further.
Between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And that will keep helping us to keep driving more amount of investments across the board.
Pipeline build that's broad-based across all three of the major platforms of our business. So we're carrying forward a lot of momentum in the large molecule manufacturing, and we expect that, which grew over 20% in fiscal 25, to flow through into 26. In discovery services, we see a strong pipeline build. One area where we're seeing that is the flow of pilot studies coming out of rebalancing of supply chains in our customer base, China plus one. And we've seen in fiscal 25, a high level of conversion of those pilots into full-grown programs, and we expect to see that momentum continue into 26. And also on small molecules, again, it's been a challenging year in 2025. But again, in the second half of the year, we've seen a number of programs and pilots come our way, and we would expect that to be expressed in an increased utilization in our small manufacturing facilities. So we have broad-based confidence and visibility in pipeline and flow-through of business, which underpins our expectation that the underlying business in fiscal 26 will be in the early teens.
So if we look at the overall quarter, let me summarize the results for you, and then I'll go into the segmental growth part of it. So if we look at our Q4 FY25, we delivered revenues of 375.2 million. This is 4.2% sequential quarter and 20.7% year-on-year basis growth. Now, if we look at it from a segmental perspective, healthcare, life sciences, BFSI, and tech, all of these verticals grew. If I look at specifically for the quarter, from a same quarter year-on-year perspective, healthcare life sciences grew by 33.6%, banking financial services by 26.6%, and software high-tech by 9.7% year-on-year. And I look at a yearly growth rate, healthcare life sciences was the vertical that grew for the company for full year at about 54%, BFSI 17.8%, and software high-tech 3.7%. So we are seeing an overall growth from a year-on-year basis. Within the quarter, the two verticals that led were BFSI and high-tech.
Welcome back. You're watching Closing Trades right here in ET Now. If you look at the markets, yes, we've taken a breather after a 7 consecutive day of rally for the benchmark indices, given the fact that, yes, you had the indications that we will be in for a negative start. If you look at Nifty over the last 7 trading sessions, 6% uptick is what we have witnessed. There are a lot of stocks that are in moves today on back of their earnings, and we will actually dissect them one at a time. For now, we also have Aditya Agarwala joining us on the show, along with Sandeep as well as Kunal. Good afternoon to you, Aditya. Thank you so much for joining us. But before I come to you, Aditya, let me actually go to Sandeep and get his view on Bajaj Housing Finance. If you look at this one, come out with the numbers, they have delivered a profit. There is a growth in the profit, but you have a lot of brokerages and analysts actually citing the fact that there is a concern, especially when it comes to the growth, given the fact that there's a reduction in the launch of the residential properties, and that could also impact the earnings or the way forward for Bajaj Housing Finance. Apart from Bajaj Housing Finance, how are you actually witnessing or actually viewing this entire housing finance space? Because yes, financials is on the top of the list top of the list of everyone's buy list rather.
Specifically, I think housing finance specific companies, I think the risk is of margin squeeze, because as the rate cuts play out and most of the loans tend to be floating rates. So you'll see a repricing of loans and the cost of funds will lag behind. And many of these housing finance companies don't have the advantage of CASA deposits of banks, where the larger banks have cut the CASA deposit rates also, and the saving bank rates also. So I think, and specifically Bajaj housing, I think it's still continue. It is pretty expensive relative to the overall financial space, even after the correction it has seen. So I would think that it will either consolidate or correct more, and anyone looking to buy could wait it out.
Yeah, that reminds me, Axis Bank, Sandeep, after ICICI Bank and HDFC, what are you hoping to hear from Axis?
I think most of these banks, we've seen that on the net interest margin, they have surprised on the upside. Most of them have given a reasonably bullish outlook for the next year and going forward, despite some net interest margin compression possibilities. Asset quality is held up. So I think if asset quality of Axis Bank also holds up like it's held up for the other banks, then I think the stock could hold on because it's much cheaper than the other larger banks, despite having strong risk management under the current CEO. I would think that if they continue to have a decent growth and control on margins as well as NPAs, there is further re-rating possibility in Axis Bank.
Since we're on the subject of Axis, let me take it across to Gaurav as well and find out what he's penciling in for the ET Now poll from the earnings from Axis this time.
When it comes to Axis Bank, we are expecting advances to grow somewhere in the range of 9%, while deposit growth could remain somewhere in the range of 7 to 8%. And as a result, when we talk about net interest income, it is likely to grow somewhere in the range of 6% on a year-on-year basis. When we talk about other income, usually Q4 is stronger for other income, but given that there are expectations that there may be some slowdown in loan book growth for Axis in Q4, we may see a lower fee income this quarter. And as a result, when we talk about PPOP, it is expected to grow somewhere in the range of 4 to 5%. When we talk about provisions, now there are no major concerns about the asset quality, but credit cost is likely to inch up to normalized level of 0.9%. And as a result, when we talk about profitability, now Street is expecting profitability to decline almost by 4% on a year-on-year basis, although it may remain healthy with a growth of around 6% on a sequential basis. When it comes to net interest margins, now Street is expecting some kind of softness in net interest margins because of the EBLR linked loans, and second is the change in loan book mix. So definitely a 3 basis point of fall is what they are expecting. But let's not forget that the peer banks have already reported some uptick in net interest margin, so definitely there is a scope of positive surprise here as well. In terms of the commentary, loan book growth and deposit growth commentary is definitely something to watch out for, and it is also very important to see how bank is commenting on the margin outlook for FY26. But definitely on the back of the numbers, we are expecting good set of numbers with some expectation of positive surprise from Axis Bank.
All right, thank you so much for that, Gaurav, for the Axis Bank preview, what we're expecting. As you can see it on your screen, you will have the management actually addressing post their earnings at 6 p.m. But let me come to you, Aditya, and let me get your view, especially on the banks, the private sector banks, because you had HDFC Bank, ICICI Bank performed really well, exceedingly well with their earnings. And that's one of the reasons why also you saw the stock price outperformance for both of them. Among these private sector banks now, which one are you liking, given the fact that most of them have seen already a good set of rally?
Hi, afternoon, Cheryl. Thanks for the show. I think a chunk of these private sector banks are looking good. Names like HDFC Bank, Kotak Mahindra Bank, Axis Bank, all of them are looking very interesting to me. And after a good run up in Kotak and HDFC, they've taken a pause. In fact, ICICI too, all three banks have taken a pause. And because results are due for Axis Bank, you're seeing some kind of a buoyancy in Axis Bank. And I think so Axis Bank has a lot of catch up to do as well vis-a-vis Kotak and HDFC Bank. So from here on, if there is no real shocker as far as the results are concerned, I think Axis Bank should see levels of 1280 to about 1320 on the upside. And apart from that, I think HDFC is also something that one should clearly have in the portfolio, more from a longer term time horizon. On the upside, you can look anywhere in excess of 10 to 12%, even from current levels as far as HDFC Bank is concerned. And similar is the view for Kotak Mahindra Bank. So all three banks, Axis, HDFC and Kotak, do really look good to me on the chart setup, and you should have them in your portfolio from a longer, medium to longer term time horizon.
All right, so that's the view coming in on private sector banks, the ones that you can actually look at adding onto the portfolio for a longer period of time. But Sandeep, do you think that now the banks have come into an overbought territory, given the fact that everyone is talking about banks? Do you think there's other sectors that also that have these opportunities wide open, and then one can actually look at accumulating right now?
So I think eventually from banks, what we'll see is that things will spread around to NBFCs, companies with benefit due to lower interest rates like capital good, infra companies, autos, etc. So I think with all of this will happen over the next few months. So I think the initial move has been led by banks. Banks will still continue to do reasonably well, given the fact that they are the largest proportion of the indices, and as foreign investor flows remain positive, a large proportion of that does goes into financials. And the other big segment, technology, where a lot of money used to go to, there the outlook is hazy. So I think financials will get a reasonable share of the money, but the rally will spread.
All right, on that note, thank you so much actually, Sandeep, for joining us this afternoon to give us your view on the markets, especially on the financial space, be it the banks or the NBFCs. Thank you so much, as always, for being a part of the show. But on that note, we slip into a break on this edition of Closing Trades with the note that the markets now are at the day's lowest point. Welcome back. You're watching Closing Trades right here on ET now. 30 minutes left to go for as we shut shop the day for today's trading session. But if you look at the markets, yes, very subdued trading sessions. We snapped the 7-day gaining streak for the benchmark indices. Let's take a look at some of the stocks actually that are moving on back of news flow. Case in point being Syngene, yes, is seeing a record intraday fall on back of a drop in their profits as well as a weak stock outlook. The other one that is actually suffering because of weak earnings is Reliance India. That particular counter also under pressure on back of the weak set of numbers coming in the quarter gone by. Nestle India also is seeing a subdued move in trade today. Remember, Nestle and HUL already come out with their numbers. Nestle right now actually trading flat with a positive bias, while HUL is down and out in trade today. 4% down to coming in for HUL. You have Divi's Lab. That one is actually seeing a very strong gain in today's trading session on back of the fact that you have Citi that has hiked the target price, and this is on back of the weight loss drugs and the prospects for that one bodes well for Divi's Laboratories, and that's the reason why Divi's is seeing a good up move. Talking about earnings back again, then you have Thyrocare Tech that is seeing the best day in about 9 months, a sharp jump in the profits. The margin also pretty strong of the company. The company has given a healthy outlook as well. So these are some of the counters to watch out for in trade today. But come tomorrow, you will have the big boy Reliance Industries that will be reporting its Q4 numbers. I have Varun standing by patiently to tell us what the street is anticipating when it comes to Reliance Industries. Varun, this time, do you think it's going to be big bang earnings or it's just going to be muted?
It's going to be a soft quarter. It's going to be a soft quarter for Reliance Industries. We are expecting the revenues to grow by around 0.5%, the EBITDA to come down by around 1%, and the profit to decline by around 0.4%, and the profit is expected to come at around 18,471 crores. The margins would decline by around 25 basis points. It will come at around 18%. That is what we are expecting. Now, what are the factors that are leading to this soft quarter for this company? So basically, if you look, the oil to chemical business and also the oil and gas business, they are expected to be weak on a quarter-on-quarter basis, although this would be offset by strong digital and retail business. But this business, the oil to chemical and oil and gas business, that is expected to show some weakness. If you look, the benchmark Singapore GRM, that has fallen around 58% on a Y-on-Y basis on weak global product cracks, and this will impact the overall business for oil and gas. If you look at the oil to chemical business, the EBITDA that is expected to be flat on a quarter-on-quarter basis but fall by around 12 to 14% on a YOY basis, and this is due to weak product cracks and also petchem spread. In fact, the overall production in the KG D6 block that would decrease despite a 2% increase in the deep water gas prices. Now, this will impact the overall EBITDA for oil to chemical business and oil and gas business as well. When it comes to other business, the Jio business, it is doing good. We are expecting the EBITDA to increase 2% quarter-on-quarter basis and around 16% on a YOY basis. And this is basically due to increase in ARPU. If you remember, before some quarters, Reliance has taken price hike. In fact, Jio has taken price hike, and that is helping the overall Jio business. The ARPUs, they are expected to grow by around 1%, and it is expected to come at around 205. Now, when it comes to retail business, on a year-on-year basis, we are expecting a 10% increase in EBITDA and expected it to come at around 6,400 crores. But on a quarter-on-quarter basis, the EBITDA for retail business will actually decline. This is because of the high base that the previous quarter had because of festival season. So, in a nutshell, if you look at Reliance, the overall performance would be soft. Oil and gas business, oil to chemical business, that would be weak. Jio and retail would be good.
All right, thank you so much for that, Varun, for outlining about what we are expecting from Reliance Industries. But remember, Reliance will be reporting their numbers tomorrow late in the evening. But today, all eyes are on SBI Life. They'll be reporting their Q4 numbers. So Gaurav is standing by to tell us what we're expecting out of SBI Life earnings. Gaurav?
Well, yes. When it comes to SBI Life, we are seeing or expecting a softer quarter in Q4 FY25, and the reason being, when we talk about the update so far, we have already seen that SBI Life has gained individual AP almost at a rate of around 13% in FY25 so far till February 2025. And when we talk about January and February, we saw mixed set of numbers because February SBI Life actually registered 0.9% decline in terms of AP growth. Let's also not forget that in the same quarter last year, we have seen a higher base, and that is the reason why when we talk about overall AP, now market is expecting around just 2% growth on a year-on-year basis in terms of AP, whereas for VNB they are expecting 2% decline on a year-on-year basis. On the other hand, when we talk about VNB margins, we may see a little bit of uptick on a sequential basis of 7 basis points, but on a year-on-year basis, we may see the VNB margins actually declining. And the reason being that we are already seeing some kind of elevated cost ratios, and second is that slower growth, which is factored in by the street. Let's also not forget that from here on, commentary on margin is something to be watch out for. Any commentary on the product mix, how it is going to change, is also something which will be key thing to watch out for, and commentary on the bank assurance and any kind of regulatory tailwinds that the management see is something to watch out for. But all in all, a softer quarter is what we are expecting from SBI Life in this quarter.
All right, so all eyes on SBI Life. Remember, today we were awaiting 5 Nifty earnings, and we already have 2 out of the way. We have 3 left to go, and SBI Life is one of those counters that will be reporting their numbers later today. But you have Maruti Suzuki that will be reporting their numbers tomorrow. Shrishti is here to tell us what are we expecting from the auto major. Shrishti.
All right, so when it comes to Maruti Suzuki, this time we have seen a volume growth of 7.5% on a sequential basis, and 4% was the volume growth that was registered on a YY basis. Factoring into that, the company's revenue is expected to see a jump of 7% on a YY basis. Definitely this volume growth led by the SUVs contribution and the higher discounts were seen to be in the month of March. That is expected to impact the numbers overall and especially the margins of the company. In terms of the we are expecting a jump of 5% here. 4,911 crores is the expectation, and the margins could actually see a bit of a decline on a YOY basis. 12% is what we are expecting because of the fact that the other expenses are expected to inch higher in the quarter gone by on the back of the Auto Expo expenses, as well as what we have seen, the e-Vitara launch. The expenses related to that will come into effect, and along with that, with respect to the commissioning of its Karkoda facility, the depreciation is expected to inch a little higher. So all these factors could bode in when it comes to the margins of the company, and lastly into the profit figure. A number of 3,801 crores is what we are penciling in, but that will be a decline of 2% on a YY basis, but sequentially an uptick is what we are expecting on this particular number. Other than that, the key to note is that the discounts were a little higher. That's why the volumes have inched up. The product mix is a bit supportive, but all eyes definitely will be on the demand outlook of the company, given the fact that for the full year fiscal, the expectation is very low when it comes to the passenger vehicle growth. So what the leader Maruti Suzuki is penciling in, all eyes will be on that. And along with that, some of the other new launches, and especially the e-Vitara launch that has already happened, what's the price range and what is the market that the company is looking forward to in terms of launching that in the first go, that is something that we will be watching out for. Back to you.
All right, thank you so much for that, actually, Shrishti, for taking us to what we're expecting out of Maruti Suzuki when they come out with their numbers. But let's get on with our experts and try and understand and engage what exactly one should do in the markets. We also have Mayuresh Joshi joining us right now. Very good afternoon to you, Mayuresh. Also, thank you, Kunal, as well as Aditya, for waiting by very patiently. And Mayuresh, yes, we're in thick of the earnings season, and looks like this time around, if you look at these FMCG majors, HUL and Nestle have come out with their numbers. Well, the street is not liking that much of their commentary. Should one read much into it, or let this quarter pass by and then maybe gauge how the FMCG counters will actually perform, given the fact that you will have the tax bonanza also at play?
Afternoon. No, absolutely. I think the two facets for FMCG volume growth are clearly hinging upon urban and rural consumption, and specifically rural consumption. Now, the expectations of a rural consumption uptake, of what we've probably seen in the last few months, gets accentuated by the fact that if there is normal monsoons, which is widely expected this time round because of La Nina conditions, the Kharif season might be extremely good, followed by an equally good Rabi season, which means the discretionary spending on the rural side should come back very, very strongly. Almost 55 to 60% of volume growth for a large part of the FMCG pool comes in from the rural market. Obviously, with the tax cuts and the bonanza that has been given out, a large part of volume growth expectations in the urban and the semi-urban markets should largely be coming back as well. And then the second half of this financial year is when I think you will see significant amount of uptake happening because of all these tailwinds coming together. Obviously, Q4 might be subdued because consumption still remains a little bit soft and patchy in all the areas as we are speaking. As far as it comes to input costs, they've largely stabilized as we speak. And if they continue on the same trend, the kind of margin performance that can come through, steady state in the first half and improvement in the second half, will create operating leverage. And the expectation in terms of volumes backed by demand, by pricing, with better margins expected to come through, can bring about better cash flows, which these companies have been struggling in the last few quarters because of tepid demand and other factors. So yeah, I think second half, I think, is where the recovery might actually start coming through for FMCG companies. At this point of time, I think a few of the beverage companies, something like Radico Khaitan, is something we're preferring on our watch list. Volumes expected to remain steady. Expectations in terms of pricing expected to remain steady and in their favor. Input cost, ENA, molasses, glass prices remain extremely stable as well. And therefore, I think we are a little bit picky and choosy within the FMCG space. But again, our own expectations is that the second half of next year, of this financial year, would largely bring about earnings recovery for a large part of the FMCG.
That's a take coming in on the FMCG space. Let me move on then, and let's talk about a sector that is actually touted to be one of the domestic-oriented sectors, and that one, when the entire call right now is looking at sectors back home, domestic-oriented sectors. Kunal, cement is the space that I'm talking about. How are you looking at it? You have Dalmia Bharat. There is a special case today because it's reacting to his numbers. ACC also is going to be reacting to his numbers because you just had the numbers for ACC a short while ago. But what's your take on this entire cement pack? Are you seeing value in this one? And if you are, then which is that counter that you are liking the most?
So I think there are two large cap which have actually been one of the better performing stocks in the entire cement pack. So the first one, of course, is Ultratech Cement. The stock has been doing reasonably well when you look at this from the context of where the markets have been poised in the last 12 months. We've actually seen Ultratech Cement being a lot more sideways. The stock is now on the verge of a breakout of a lifetime high. So I think that would be another positive for the entire cement sector, that the leader from the entire cement pack, that's the one which is continuing to move up higher and showing signs of strength. And then the other stock which is also very interesting in terms of a potential breakout would be Shree Cement. The stock, I think, has been off the radar for many short-term investors because very recently also I think the stock had come out of the Nifty 50 basket. So I think post that we've actually seen the stock initially going to a corrective phase, but the comeback for Shree Cement has been on the much more positive side. And that, I believe, could be a very strong indication that we are looking at a change of trend for the stock. I think it's placed closer to 30,000, 30,500 plus mark. Already, confirming a fresh, I think 1 year high, 52-week high for Shree Cement. Looks attractive at current levels and would peg the targets higher to almost 32.5 to 33,000 for the next 6 to 12 months.
All right, so that is Shree Cement. But let me get actually the closing ideas from you, Aditya, as well as Kunal. Aditya, you go first. Any closing ideas that you have for our viewers?
So I've got a couple of buy recommendations. One is from the pharma space that happens to be Sun Pharma. Cheryl. I think this is an interesting stock to go for. And the entire pharma basket is witnessing a shift, sectoral rotation and buying interest. So Sun Pharma at current levels for me is a buying opportunity for a target of 1900 with a stop loss at 1750 on the downside. The second stock is Hindustan Zinc. This is also one stock which has come back strongly and has broken out from a downward sloping channel as well. So for a target of 490 on the upside, I'll be a buyer with a stop loss at 445 on the downside.
That is one from the pharma space, one from the metal space. Kunal, what about you? What's your closing trade?
Mid-cap IT space. So that's a one OFSS, Oracle Finance. You know, a very interesting chart. In the last 5 to 6 days, we've seen the stock moving up almost 700 to 800 points. Now moved up about that 8,500 plus mark. So I think looks extremely attractive from a short-term play. Would look out for a higher target close to 9,000 to 9,200.
So it's a mid-cap IT counter that Kunal is liking. But are you liking the mid-cap IT space by any chance, Mayuresh? Given the fact that IT, it's a no-go area for most of them at this point in time, given the fact what is happening globally, the uncertainty is rising. No doubt HCL Tech's guidance was much better than the street had anticipated. On back of that, you saw this entire IT pack see a good solid move yesterday's trading session. But what's your take? How should one actually play the IT theme, given the fact that, yes, these are strong, sustainable business and having global exposure? What's your take? Would it be a mid-cap IT play or a large-cap one if you would want to go for it right now?
No, so honestly, I think it still looks a little hazy. And therefore, I think we will wait out for the next few weeks. Let the Trump tariff deadline probably come close. What probably comes out of that at the end of 90 days? How many countries negotiate, what happens with China, how do we strike a deal? And therefore, I think what will be the global macro positioning at the end of the 90-day period is going to be extremely critical. Obviously, I think looking at commentary specifically for a few large names, a few mid-cap names as well, the macro environment still looks a little bit tentative. Expectations in terms of discretionary spending still looks back-ended. And the hope is that the second half of this calendar year, orders will start coming through. A lot more stability will start coming through for the sector and for a lot more as far as BFSI retail manufacturing is concerned, both in North America as well as the European regions. Having said that, our own sense is that HCL Tech proved to be an outlier among the large cap names. Persistent had a decent set of numbers within the mid cap space. We would ideally like to watch for emphasis numbers as well, which are expected today, because they've done a lot of work as far as generative AI is concerned. And if they're able to give a decent set of numbers with decent commentary as far as Gen AI, I think that is the segment which is expected to roll out and do very, very well from an IT perspective as well. And therefore, I think we would love to watch out for emphasis number. To answer your question, at this point of time, we're waiting and watching. We just want to see over the next few weeks how things play out on the global macro scale, and then probably take a call on the sector.
Wait and watch mode when you talk about what exactly is happening with the IT space, given the fact that you have a lot of commentary coming in day in and day out, and it tends to get a tad bit difficult to actually gauge that sort of a space. But Mayuresh, coming back to you, I wanted to understand about your take, especially when you talk of the financial space, because, you know, all bets are now riding pretty high on the banking space. But when you talk about the financial space, leave aside banks, you also will have the NBFCs, you will have the entire financialization theme also at play. So in that you could also add maybe a not capital goods, I beg your pardon, it's capital market play as well. So when you talk about this entire space, do you look at it wholly like an entire BFSI space, and which one are you liking in that apart from banks?
But again, I think it's a consensus call. I think most analysts, whether it's fundamental or technicals, are liking the space as a whole. Obviously, from a fundamental perspective, the valuations still seem to be reasonable. The expectation in terms of earnings growth expected to continue, in terms of balance sheet expansions, continues for the space as a whole. And the tailwind and the backdrop obviously becomes an interest rate cut cycle. So if you're probably looking at an interest rate cut cycle at some point of time in the second half, globally and locally as well, I think that creates additional tailwinds and buffers. Obviously, what RBI has done in terms of liquidity provisions for the banking system as a whole, what RBI has done in terms of the risk weightages in the past few weeks, the past few months, that has given good enough confidence for the system. And therefore, I think if you leave aside banks, insurance as a space, again, I think largely expected set of numbers how the growth dynamics play out, specifically in terms of APE numbers, in terms of VNBs, and ultimately in terms of the embedded value itself, is going to be very, very critical. Obviously, the product mix is changing, and therefore, I think the kind of commissions that are getting charged as a percentage of the overall cost structure still remains elevated as far as a large part of the insurance pool is concerned. And therefore, I think if you focus on NBFCs selectively, our own sense is that select housing finance NBFCs might continue doing well. Case in point, PNB Housing, the affordable segment that they're foraying into, obviously a high yielding segment, but an equally risky segment as well. But the experience that they've probably gathered from the emerging segment over the past few years gives them the confidence in terms of credit underwriting for the affordable segment that they're probably foraying into. And therefore, I think the book that they've probably got, which is largely retail oriented, 70% housing, a large part of the self-employed pool is also asset-backed to a large degree. And therefore, asset quality pressures should not be too accentuated in terms of housing finance balance sheets. And therefore, PNB Housing, Canfin Homes probably looks like a very interesting bet. Within the broader universe, the microfinance stress might still continue as far as Q4 is concerned. But again, with the expectations of urban and rural recovery expected to happen, a large part of this MSME pool might actually start recovering as far as earnings is concerned as we head into Q1, Q2 of this financial year. But at this juncture, I think housing finance companies within the NBFC space, ratings, rankings, institutional holding, as we look at it from a cancelling perspective, all look very, very attractive.
All right, so that's the entire take coming in on the BFSI space and the themes that actually Mahesh is liking. Even housing finance theme is also a part of that. But Kunal, let me come to you and get your view actually on the banking space. At what point in time would you believe that the Nifty bank is at an overbought zone, given the fact that now everyone's talking about banks and a lot of them have actually increased the exposure in the banking space, so much so that now if you look at the Nifty bank, it actually hit a record high level on an intraday basis this week. So what's your take? At what level would you say that the entire banking area, banking zone, banking index is at an overbought zone?
See, I think just yesterday or day before when Bank Nifty touched 56,000 on the spot mark, for a shade entered into the overbought kind of a territory. But what we have to look out for is that is it overbought basis on the history of the last 3 months, 6 months of the price trend? Then there is a concern for the banking index. But if it's overbought just because there has been a spectacular short-term rally, that indicates that the cool-off may not be very severe for that kind of an index. It could actually be more of a time-wise consolidation, and that too may be restricted towards just about 3 to 4 odd trading sessions. But I believe that the retracement may not be very severe on the downside for the banking index. So I think we've already saw traces of banking index coming into the overbought territory. And I think the last 2 days, what we are seeing is, yesterday also the Bank Nifty was down. Today it's down by 150 to 100 points so far. And that's also because of the churn which is happening from banking stocks to the other sectors, and also adding to that the expiry trade. So I think on the back of this, it could just about be a few days of a churn. What matters over here now is that in case, if say assuming over the next couple of days, if this minor correction for the Bank Nifty extends, and if there's an opportunity where the Bank Nifty falls below 55,000 mark, that I believe could be a very good opportunity for a short-term trader to try and look at initiating a contra buy on the Bank Nifty as well as on many of the other private sector banking as well as the PSU names.
All right, so that's the take coming in on the banks, on the charts. Let me come to you, Mahesh, get your take on the pharma sector, because today that one is an outlier along with metals, given the fact that it is seeing a very solid up move. But there are a lot of stocks moving on stock-specific news flow. For example, you have Citi's note that has actually made sure that DVs is trading well in trade today. They've upped the target price. You also have Lupin, Eris Life Sciences. They are gaining on the insulin market share prospects. But how should one actually play the pharma theme, given the fact that there's a lot of news flow that is marring their performance for this one?
So I think there should be consistency in reported numbers as far as the entire sector is concerned. And therefore, our take is that with a lot of work that has been happening specifically in terms of select NDAs, select ANDAs, select FTFs, the specialty pipeline that a lot of leadership stocks within the space have probably developed. A few of these pipeline drugs are in late stage stages as well. And therefore, I think the market size of these drugs is pretty huge. The margins at which these drugs might come into the market are pretty huge as well. And the exclusivity period works for them as well. And therefore, I think pharma companies selectively should continue doing well as far as earnings is concerned. Our own sense is that the resilience shown by a few large cap pharma companies might actually continue. The RS ratings as we see it, the EPS ratings as we see it for a few companies indicate that the price stability is backed by earnings stability. And therefore, a stock like Sun Pharma, which we continue holding in our global portfolios, and all the arguments that are put forth, very strong pipeline that they've probably got, expectations in terms of resolutions of the plants, if any, which have been FDA, which are having FDA concerns if they get resolved. I think that adds fillip in terms of more earnings or improvement in earnings expected to come through. So I think a few of the leadership stocks like Sun is something that we continue holding. Within the mid-cap universe, Strides Pharma as an example is something that will continue doing well. The merger that probably has happened of the acquisition itself will mean that the overall EBITDA margins, the overall ROEs, what we look at as a benchmark, 18.5%, completely satisfies our earnings predicting factors. The pipeline of drugs that it probably possesses and the return ratios that it probably has with a very, very healthy balance sheet gives us the strength with a very solid institution holding as we see it in cancer. So I think a couple of stocks I think continue to hold and like in the pharma portfolio.
All right, so that's some of the picks coming in from the pharma portfolio. But quickly, Kunal, 3 minutes left to go while we shut shop trade for today. Let me get your BTST ideas.
So there'll be two buy calls. The first is about GMR Airports. That's a chart which has managed to come back above its longer term averages. So would look out for 94 as a target. Stop loss could be kept at 85. And the second would be about Bharti Industries. That's a chart which I believe is making a very strong comeback. Excellent volumes over the last 1 month for the stock from the sub 400 mark, where the stock made a near to medium term bottom. So we'll look out for 460 as a target. Stop loss at 435.
All right. Aditya, any BTST ideas?
UPL is looking very interesting to me, Cheryl. At current levels, I'll be a buyer for a target of 720 on the upside. Maybe place a stop loss at 670 on the downside.
All right, so those are some of the BTST ideas coming in from our experts. On that note, I'd like to thank you, Mayuresh, Kunal, as well as Aditya for joining us on the show to talk about the strategy one should adopt, especially talking about the banking space, IT, as well as pharma. Thank you so much for being part of the show. But if you look at the markets right now, as we are shutting shop for today's trading session, it looks like a subdued day of trade. We've taken a breather after 7 consecutive days of rally for the benchmark indices. Nifty shutting shop below the 24,300 mark. You have Nifty Bank once again underperforming the benchmark indices. But let's not take it away, given the fact that Nifty Bank on this week has already hit a fresh record high levels. Not too bad picture coming in for the advanced decline ratio. We're neck to neck when you talk about the advanced decline ratio. A lot of stocks actually reacting to its numbers. HUL, Nestle, both of them actually being subdued on back of the numbers. Apart from that, take a look at ACC, Syngene, as well as Thyrocare. These are some of the marked performers on back of their earnings, with Syngene taking a knock of as much as 13%. You have Thyrocare on the other hand seeing a jump about 9% or so. Divi's Laboratories, Lupin, Eris Life Sciences, these are some of the counters in the pharma pack that were a buzz in trade today, with Divi's Laboratories hitting the upper circuit of about 5%, Lupin positive, Eris Life Sciences also positive in trade today. Take a look at some of the other names like Reliance India. That one also saw a sharp knock on back of the fact that the Q4 loss had widened. Apart from that, there are some other counters like Bharti Airtel that's seen a sharp knock in the last 1 hour of trading session. Hindustan Bank, on the other hand, seeing a sharp jump on back of multiple block deals. You also have Tata Consumers that reacted weak for its numbers as the margins. There's a concern on the margin front, so you have Tata Consumers that saw a knock, but now towards the day end has actually recovered from the day's lowest point. You also have Bajaj Finance that hit a record high level on the fact that they've said that they'll mull share split bonus share issue as well. Dalmia Bharat, on the other hand, hit a near 7-month high on back of stellar set of earnings. If you look at the market, yes, nothing to complain about given the fact that we've seen a sharp rally for 7 consecutive trading sessions. Today, a subdued market is what you can see, but yes, only mild cuts coming in for the benchmark indices, with Nifty now shutting below that 24,300 mark. You have Sensex shutting at around 79,800. So that's the way how we shut shop for trade today. But let's remember that come tomorrow, you'll have a lot of big earnings to watch out for. It's a good buy from Michelle D'Souza and the team that put the show together. Thank you so much for watching.